Hello everyone, the stock market ended last week on a strong note, with major indices clocking their biggest weekly percentage gains since June this year. Most stocks closed higher on Friday, so are we in for a nice rally? In this video, I will share 3 possible reasons behind the sudden rally, of which one is particularly interesting. In addition, I will also share my view on how things could potentially pan out in the next 1 to 2 weeks, as well as my investment plan to end of the year, so do stay on to find out more. Okay, so why the sudden random rally towards the end of last week? In my view, the trigger for this abrupt upside move was likely due to 3 reasons. First, it could be a report from Wall Street Journal on the Fed's signals to slow the pace of interest rate hikes. Secondly, it could be the earnings reported by many companies did not turn out to be as bad as most investors feared it would be. And finally, it could purely be a technical play or manipulation from market makers, aka the institutions or hedge funds. Let's do a quick breakdown on these reasons. On Friday, Wall Street Journal reported that some federal officials are concerned about over-tightening with large rate hikes. They are thinking about slowing rate hikes after a likely 4 straight 75 basis point rate hike in November. This then opens up a debate that there could be a smaller interest rate hike in December. As we are all aware, the Fed's aggressive rate hikes have been a major reason why the stock market has fallen into the bear market territory this year, and many investors are guessing and waiting for Fed to pause or stop their interest rate hikes. So with this latest report, it raises hopes that the Fed could adopt a less aggressive policy stance from December onwards, and the report appeared to have boosted the stock market. In my opinion, this seems to be another sentiment rally, aka a rally fueled by hope. And we all should know that hope is not a strategy, and so far sentiment rallies have not been able to sustain. Interestingly, this report came right before the blackout period for the next FOMC meeting. In case you are not aware, the Fed officials are not supposed to speak to the public on monetary policies the second Saturday preceding a FOMC meeting. So here's my conspiracy theory. That is, the Fed is trying to pump the market into elections. I am thinking the politicians wouldn't want the market to hit another 52-week low during elections period. I mean, to be very honest, I find it amusing that just a month ago, the Fed was so persistent about massive rate hikes to keep inflation down, and they even mentioned that some pain is necessary. They also mentioned not to prematurely pull back the rate hikes, but now they are changing their narrative? Seriously? Is it because the election is coming? Anyway, a quick disclaimer, this is just my wild guess with no concrete evidence, hence a conspiracy theory. Please take it with a tablespoon of salt, alright? Next, the market could have rallied because a large number of companies which reported their earnings have beaten the analyst estimates. But it is also worth highlighting that the hurdles are relatively low under the current climate, so beating these estimates should not be too tough. Anyway, that being said, more than 70% of S&P 500 companies so far have reported a positive surprise in terms of earnings per share, so that's sort of a good news for the stock market. Lastly, again a wild guess, the market rally on Friday could be because of OPEC's week. In case you're not aware, last Friday saw 2 trillion worth of options expired. As they always say, market makers will try to control the price in a way that it inflicts a maximum pain for option traders. To put it simply, when the market is super bearish and many retail traders are buying put options, institutions can bring the market up a little, just enough to wipe out the put options. Alright, looking ahead, can the rally go into next week? Yes, it can, but it will be largely dependent on the earnings from the various tech giants. Some of these biggest companies include Apple, Alphabet, Microsoft, Amazon, and Meta. Separately, I found a fun fact that is related to the midterm elections. So apparently, in the 20 midterm election years that occurred during the same period, the index gains averaged 7.6% in the 3 months following the election, and 14.1% in 6 months after election day. In all of those post-election timeframes over that almost 100-year period, only 3 were negative. So, are we really going to rally into November and even year-end? I think there could be some possibility, as traditionally, year-end seems to be a good period for the stock market. And now we have the elections. Potential short-term catalysts? But a very huge caveat here, past performance is no indication of future performance, and do note that all rallies have not been able to sustain so far this year. Personally, I will look out for 2 things. One would be the big guns have to report not so bad earnings, and secondly, it's more of a technical aspect. I will watch the support levels closely for S&P 500 and some of the mega cap stocks to determine if the rally can continue. But to clarify, at this point, I would think any rally is just a relief or bear market rally. Meanwhile, if you have learned something till this point, do help me with the like and subscribe buttons as it can improve the visibility of this video. I'm doing all this for free in hope to share my knowledge with more viewers. Thank you. Okay, let's move on to the technical segment, starting things off with SPY again. Remember last week I mentioned that SPY has tested the weekly chart's 200 moving average only on 4 occasions, and this moving average should offer some form of support. And last week, SPY bounced off the moving average and closed nicely above it. To add on, there is a bullish divergence spotted on the RSI, and these are bullish signals. Come next week, let's see if SPY can get above the green upward trend line, which is around 379-380. Moving over to the daily chart, there were 2 bullish moves. First, it went above the 23.6 Fibonacci retracement level, and secondly, it broke above the downward red dotted trend line after retesting it on a few occasions. To me, so long as 367 holds, we could fly to 379. In fact, last week I mentioned that if we break above 367, then we could potentially bounce up to 379. And that's quite a fair bit of upside where gutsy traders can try to ride this rally. Looks like we are still on track for that. In my view, as long as the tech giants report a decent earnings, the chance of SPY heading towards 379 is relatively high, and it could perhaps even break above it. My take is that the heavier resistance will come in only around 387 to 389 range, where the 50 moving average is as well as where the next Fibonacci retracement level sits. It may sound scary to go against a bearish market trend, but I am just reading off the chart and I could be very wrong. Okay, on the downside, the market will be very bearish again if we fall back below the downward trend line, with a small support at around 357. If 357 breaks, we could then retest the recently created 52-week low at 348. Not financial advice, but at this junction, I would not buy any put options unless SPY goes below the downward trend line again, because right now, the potential of upside is higher than downside. Again, earnings from the giants can make or break this possibility. Moving over to Apple. Apple looks slightly bullish at the moment, namely because it has been creating higher low over the last 1 week. In addition, it has closed above the first Fibonacci retracement level of 144, and at the same time, MACD has curled up since the start of last week, with further room to go. If Apple doesn't give a too shabby earnings and estimates, we could fly towards 150 and even 155. In my view, 150's resistance is a weak one, and the heavier resistance will only come in around 154 to 155, where the 50 moving average and 50% Fibonacci retracement level are. The even heavier resistance is at 158, which is the 200 moving average. Therefore, if Apple gives investors some vote of confidence in terms of their earnings and forecasts, we could potentially have a 10-point upside, and in Apple's context, that's quite a fair bit. But of course, a stinker from the US biggest company will bring us down to maybe around 138, where the next support is. However, this support in my view is a relatively weak one, and if deep buyers don't step in, we could test the recent low of 134 again, and could even fill the small gap between 132 to 133. Similar to SPY, my take is that the probability of upside is higher than downside, but please do not follow blindly, do your own research, okay? Next, let's have a look at Tesla. In my last video, I shared that when RSI hit the wrong bottom for Tesla on previous occasions, it usually had a rally. Then, I posted on Moomoo that there is a possibility that Tesla could close the week above 200, likely due to market makers trying to wipe out those put options with 200 strike price. And here you go, we had a rally towards the end of last week, and Tesla indeed closed above 200. Looking ahead, it's going to be a very interesting week. Reason being, the blackout window for Elon Musk to sell Tesla shares has ended, and this means he may sell his shares as early as Monday if he needs the money to secure the Twitter deal no later than 28 October Friday. And if he does it, I think we can temporarily throw away the technical chart because the stock will just waterfall down for a while, as what we have seen late last year when Elon had to sell his shares. But of course, things could change if Elon found other means to raise funds, or if Biden stepped in to intervene or stop the deal, or if the deal gets delayed for whichever reasons. Anyway, let's still have a look at the chart. On the upside, there is a little gap between 215 to 217, and I think the probability of filling it is quite high. And say if other companies report good earnings and Elon is not selling shares, we can expect Tesla to head towards 230 and also the gap between 234 to 235. In my view, heavy resistance will only come in at around 246 to 247, where the 38.2 Fibonacci level as well as the green upward trend line are. If this rarely happens, shorts who entered when Tesla was below 205 will have their premiums wiped out. On the other hand, if say Elon starts selling shares or market makers were done with controlling the price above 200, we have a support at 204. If that breaks, be prepared for Tesla to head towards 188 to 190, where there is a gap pending to be filled, after which 180 should offer some form of support. Okay, one last thing to highlight, there is like a bear flag forming on the daily chart, and if it is confirmed, then I think we are very likely to break below 200. Watch how the price moves in the next 1 or 2 weeks. Okay, for Google, as mentioned previously, it has been trading between 90-ish to 100-ish. Specifically, the support on the downside is $90, while the resistance levels on the upside are 105 and 120. Something to highlight, it seems like there is a potential bear flag formed, and this is a bearish signal if confirmed. So watch carefully how Google moves this week as it reports its earnings. If it can break and stay above 105, then that's good for the bulls. Otherwise, we could potentially break the recent low of 104 and a new 52-week low will be formed. In short, this week will be very crucial for Google. On option play, as Google is trading sideways within a tight range, which is good for option sellers like me. I have sold a cash secured put option with 90 strike price and a covered call option with 105 strike price. And if Google trades between these two levels before option expiration dates, I will profit from both contracts. At the moment, my put option has expired worthless. I am waiting to see if there is opportunity for me to sell another put option just before the earnings report when the implied volatility is high, which means I can get more premium. Just to share, I managed to make a 75% profit in 2 days during the last quarter's earnings, where similarly, Google was put down by Snap's earnings, and I took the chance to sell a put contract. Then Google's earnings turned out to be not so bad and it rallied. But this time round, seeing that there could be a bear flag forming, I may have to be very careful in choosing my strike price. My view is that the stock market anticipates and looks forward, so don't wait for the dust to completely settle, and don't expect the stars to align nicely for you before taking actions. We are almost 1 year into the bear market, and bear market average lasts around 10 months. Well, it can definitely go beyond that time frame, but the biggest question here is, can you accurately predict when will the bear market end and where is the exact bottom? No, you can't, so why not sweep up some good companies at discounted rate when you can now, especially when many of them had hit their 52-week low recently. The point here is don't leave it to fate, take matters in your own hand. Just to share, I am glad that I have been picking up shares in September and October. So if the market rallies now till year end, those shares that I have picked up will be in green. And if the market falls, I will continue to load up more based on the target prices that I have shared in my previous videos. These target prices may change when the overall market sentiment or macro change, so do like and subscribe to my videos to keep yourself updated on my target prices. Okay, my short end thoughts for this video. The current rally is showing some strength, so don't get locked into a permanent bearish mindset. But at the same time, given the weak macro factors, you also wouldn't want to get too excited and start pumping huge money into the stock market with every small little rally. Earnings season could make or break the overall market trend temporarily. Look at Snap, it reported poor earnings, and companies like Google, Meta and Pinterest all got put down. So do remember this ripple effect as we enter a huge earnings week. Alright, that's all for this video. Have you bought the dips in the last 2 months? Let me know in the comments section below. And lastly, if you think my video value add to your research, please help to hit the like and subscribe buttons. Thank you.